Good afternoon, it's Lon Welsh at Ironton Capital, and I want to share some information with you on using your Roth IRA with us at Ironton to save on your taxes. And I think you're going to find this to be some very, very actionable information if you've got any kind of a self-directed IRA. So a quick note from our attorney, the material in here is confidential. You can share it with your friends and family, and of course with all of your financial advisors and your attorney, but please don't distribute it beyond that. Any type of investment involves risk, so you'll want to talk to your financial advisor, your attorney, and your CPA to understand what risks are in this particular set of ideas and if they apply to your situation or not. I'm not a tax professional or an attorney, so I can't offer you opinions on that. This is not an offering of an investment opportunity. If you find this to be interesting, we're happy to share with you the legal documents that give you all the risks and all of the details of our different funds, but this communication is not an investment opportunity. We have a lot of forward-looking statements in this about should, expect, plan, seek, anticipate, believe, estimate. These are all based on our best estimates of the best information we have at the time, but of course, it's a continually changing market environment, so you'll want to take our information, review it yourself carefully, and check with your advisors before you proceed on it. And lastly, there's a lot of company-sourced information in here, so it's the best information we have available, but of course, you'll want to put this together with your view of the economy and where the economy is going. So I'm required to tell you all that. It's out of the way. So I recently found a tax management strategy that I think a lot of you guys will be able to use. And again, I am not a CPA. You need to talk to your CPA about this, but I'm excited for you to explore it. So my situation was this. I had a self-directed IRA. So I used to work for a company a couple years back. When I left the 401k there. Then I transferred that 401k to a self-directed IRA at Vanguard, put it in the stock market for a lot of years, and then I learned about this strategy. So I created a self-directed IRA with a custodian, someone like New Direction. I'm using Provident. There's many of them. And if you need any help, I can advise you on what we have seen from our other investors for self-directed IRA custodians. And the difference is that when you're with Vanguard or Fidelity, you can only really invest in stock funds and bond funds, and maybe you could buy, gold or platinum, but you're limited. You can't invest in real estate or real estate funds. If you work with someone like Provident or New Direction IRA, you can invest in pretty much anything that you want as long as it's within the IRS framework. So I made 7 investments in different real estate limited partnerships, just like NDF1 and NDF2. So what I didn't realize is that after I had had that investment for at least a year, I could get an opinion letter from a CPA about what the FMV, the fair market value, was of the investments that I made. And since I invested in limited partnerships, just like you would be with us, I don't have any decision rights about how fast this apartment building gets built. I don't control what to do with the proceeds of the quarterly distributions, and I don't control when we make the decision to sell it. The general partner I invested with has all those decision rights. As a result, my investment is probably worth 25% less than the money I put into it. And then it's not liquid. So if you've got a traditional IRA invested in Apple stock, you could decide, I'm going to sell this. And there's a market. You'll sell it tomorrow morning at whatever that price is at that moment. There's nothing like that for these real estate limited partnerships. So as a result, you will trade at a discount to fair market value. So in my case, if I put $100,000 into a fund, my fair market value in my particular situation, which might be different than yours, came back at $50,000. So I did that for all 7 of my investments, and then I converted it from a traditional to a Roth. So if I had, let's say, $100,000 in total across all 7 investments, the new fair market value was $50,000. When I do the conversion, I have to declare that $50,000 as income to the IRS that year. If my marginal tax bracket is 30%, 30% tax bracket, $50,000 of income, I have to write a check to the IRS for $15,000. And I can write that out of my personal checking account. It doesn't have to come from the IRA checking account, which is really, really good news to know. And then this investment then will grow tax-free for the rest of my life, which is absolutely fantastic. There's some other great things about this too. When you invest in your IRA in a real estate limited partnership like ours, there's something called UBIT, Uniform business interest tax, I think is what it is. I've got another later slide where we can give it to you. So when something gets sold in your limited partnership and it creates a profit, there'll be a small UBIT tax liability that's created. So for you to invest with us, that doesn't create a problem, because when we sell something, let's say that you invested in 10 different things in NDF8, and one of them was building an apartment building. We build the apartment building, we run it as an operation, we find a great buyer, we sell it. That sales event creates a tax liability for you under UBIT. That's going to be in the same tax year that we're going to send your initial investment back, as well as all the profit from that deal, most of which will be a long-term capital gain. So you'll have a big pile of cash landing in your IRA from us. You could take a little bit of it and tell your IRA custodian, hey, send this much to the IRS. Your CPA will help you calculate how much it is. It won't be a lot. And the rest of it, you can redeploy it however you wish to invest it, in the stock market with us, or whatever else you want to do. Once you've done the conversion from a traditional IRA to this Roth, my understanding, talk to your tax advisor, is that you don't have this UBIT exposure anymore. So it solves that problem. There's another really great gain about this, and that's the RMD, the required minimum distribution. So if you've got money sitting in your normal traditional IRA at some age, your tax advisor could tell you for your circumstance, I think it's like 70 years old. When you get to be 70, you're required to start taking some money out of your IRA each year, whether you want to or not, because when you take the money out, the IRS will tax it, and they want the taxes. So if you convert this to a Roth, there's no more RMD, required minimum distribution. So that's extremely helpful, because you may not want to sell. You may have enough income from other sources that that's not an optimal answer. And now you're making the decisions. The IRS is not making the decisions for you. Lots of really great things about this strategy. And if you talk to your CPA, there might be unique things in your situation that I didn't have that make it even better for you yet. So let's go through this in a little bit more detail. So you've got a $100,000 balance. You're 45. It's all at Vanguard and the Standard & Poor's 500 index fund. You want to start taking cash out at 60, and you're going to live till you're 80 years old, we're going to pretend. And we want to figure out what amount of cash could you take out so that you'd have like roughly equal payments between age 60 and 80 during your retirement years. And I want to show you what this would look like if we just did it in our self-directed IRA traditional, or if we did the conversion in the Roth, and then show you how much incremental wealth can you generate for your family with this strategy. So you can email me, and I'd be happy to share this little Excel sheet with you. It just has like 6 numbers you have to punch in. The value of your IRA, how much do you think your current investment would grow if you didn't do this? So if it's a stock fund, 10% is a good guess. What's your marginal tax rate going to be when you're retired? So if you have a lot of income, maybe it's 35%. If you don't have much income, maybe it's 25%. Your CPA would be able to help you with that. How fast would your investment with us in a national diversified fund grow? Our target is 17 to 20%, so I put in 17. And then how much will this fair market value take down the value of your assessment? So in my case, I cut it in half. When I was preparing for this presentation, my tax advisor said, not everyone's going to get half. Some people might only get, say, 35%. Everyone's going to be just a little bit different. So I was conservative here, and I put 35% in, but your number might be a little different. And then what tax rate do you have to pay the IRS when you make this conversion to a Roth? So I'm assuming you're in a very high tax bracket right now, so I put in 35%. If you're in a 25% tax bracket because you're a lower income household, or maybe you're just very good at managing your taxes, so you don't have to pay much tax, this is where you would change it. So those are just the 6 things you punch in. So let's take a look at how much money you'd be able to take out of this IRA in these different scenarios. So if you do nothing, you're going to have $100,000 today. You're going to have it in the stock market. It grows 10% a year. When you're age 60, it's grown to $417,000. And you could take out $48,000 a year before tax, or $31,000 a year after tax. And if you add up, you'd be able to take that out for 20 years. If you add it up after tax, you'd take out $655,000. That's if you do nothing today, which is pretty amazing considering you only have $100,000 sitting in that account today. Absolutely incredible. So let's imagine that you decide to put it into a self-directed IRA, and now you're going to invest in one of our national diversified funds. So you've got the $100,000 today, but now we're investing in NDF real estate as opposed to in the stock market. You're going to be able to take out $180,000 a year pre-tax or $120,000 a year after tax just by making this one change. So in your retirement, you're going to be going from $31,000 a year to $120,000 a year. So a 4 times increase in what's available to you and your family to support your lifestyle. So let's take a look now if we did the Roth IRA conversion to optimize the taxes. What impact would that have? Well, what you see is you have $100,000 today. We're going to invest in the NDF, National Diversified Fund. We're going to wait a year, do the fair market value study, convert to a Roth, and we're going to pay a little bit of taxes right away, $22,000 today. But that's the last tax bill we're ever going to pay. We're going to find that by the time we retire, that we've got our balance is now at $850,000, which is a little bit less than if we would not have done the conversion. But the difference is we don't have to pay the taxes ever again. So if we don't do the Roth, we're going to have income of 120. If we do the Roth, we could pull out 150. So your income goes from 120,000 a year to $150,000 a year by doing the Roth conversion strategy, paying a little bit of tax up front, and then not ever have to pay any taxes ever again. So the biggest part of the wealth enhancement is moving from the stock market to National Diversified Fund in your IRA. And there's a small extra gain of icing on the cake on top of that from doing the Roth IRA conversion up front. So your situation, of course, will be a little bit different. Talk to your CPA, maybe play with that little model, and then you can see exactly what it'll mean for your family. But I know that you'll be quite impressed with it. So let's talk about the unrelated business income tax. This is just a quick example. Let's imagine that we've got $100,000 of equity and we generate a $10,000 profit, and we've got some depreciation. We've got some cash flow that comes out. And on this other one, this one has no debt. We just paid cash for this real estate. On this other property, we bought a bigger property and we got, say, $300,000 of property, $100,000 of equity, $200,000 of debt. So our debt ratio, our loan to value, is 67%. In this case, we would have to pay about a $3,400 tax on the cash flow from this property. So in most of the cases I've looked at with CPAs, this UBIT is a relatively small amount of tax within your IRA. Your CPA will help you calculate it for your exact situation. The most important thing is you just don't forget about it. Believe me, we will remind you all the time as we're selling stuff. Please talk to your CPA and send in a check to the IRS for your UBIT just so you don't get in trouble for not filing it. But it's a very minor tax. Just want to make sure everybody who's considering this is aware of what they need to do. The required minimum distributions, this law changes frequently. So here's what it says right now, is that you have to start taking a distribution out of your traditional IRA when you turn 72, or if you're 70 and a half, if it's before 2020. And they take the fair market value of your IRA to calculate out how much you have to take out. There's a formula for this. I'm not going to try to do a tax law class here. Your CPA can help you out with it. The challenge is that if you fully invest your IRA in real estate and it's not liquid, when the minimum required distribution comes around, you may not have any cash sitting in the IRA to make the payment, and it puts you in a bind. So the answer would be, well, I've got to keep some cash on the side and not invest all of it. Well, the cash on the side doesn't really develop much of a return. It's really a suboptimal strategy. By doing the Roth IRA conversion, you bypass all this headache. Okay, I thought I'd share with you my fair market value study, just in case you're curious what it looks at. So you can look at this in the PowerPoint and read it all. But basically, if you take a look at what we invested in for Fund 1, one of my investments was called Sawmill Capital. That's the apartment complex we built in Chicago. And they decided that my fair market value was like half of what I initially invested. So I think I put in $100,000 in my IRA. So they said it was worth 50. And then the CPA signs a letter, gives all this other detail to the IRS. And here's the control discount that we talked about and the lack of marketability discount. So the fair market value after these discounts is X. I just gave this letter from my fair market value CPA to my IRA custodian, and he marked down the value for us. It was very easy to do. Heidi and her husband like the access that Ironton Capital provides to the geographically and diverse sectors real estate portfolio that's carefully curated with a fund structure, transparency, and modest approach of a national diversified fund. It's well suited for investors who are new to this type of investment class. As Tom explains, determining where to invest is incredibly challenging in this environment. Lon has a freakish ability to understand and analyze real estate deals and know where and when to direct funds for maximum gain. Like Justin, who's been able to transition their hard work as a small business owner into a passive portfolio. Would you like for us to do an investment review for free? Go to irontoncapital.com/review and choose your time, and we'll be able to deep dive with you on your personal view and goals and answer any of your individual questions. Sound good? We have a lot of projects in the works, so our time is limited, so please go ahead and secure your spot now. We can't wait to see how we can help you with your investment goals as our gift to you.